So here we are looking at applications of the knowledge and the ideas and the strategies that we've reviewed in this reading. Now it's important to reinforce at this point the style of the level 3 exam. It's very likely in the exam that rather than explaining the technical details of a strategy, or rather than doing a detailed calculation as to a fair value or a profit or loss, it's much more likely that you'll be given a case in front of you and you're being asked to determine which out of a kind of a menu of strategies would be most appropriate given a client's objectives. Level 3 is very applied, is very much about solving an investment puzzle, coming up with a solution for an investment situation that is in front of you. Most of the time in the exam you're looking at discuss as a command word, or you're looking at determine and justify, and that's what's happening here at the end of this study session. So make sure you follow through these basic examples. It might seem like a bit of overkill. It might seem like we're just talking about things that we've already spoken about during the reading. However, the key thing is the application. The key thing is that we're looking for what types of clients would require what types of strategy. So we know what all these are, but first up, who would want to do, what sort of client would want to engage in a covered call? We know what it is. It's like for the upteenth time, you know, a covered call is long the underlying and selling a call against it. So here we've got an investor that owns the stock, right? So they're already owning the stock, plus S, owning the underlying asset. They haven't got a bullish outlook in the short term. They've got a bearish outlook for a relatively short term. They're asset rich and they're cash poor. So in order to alleviate this cash poor situation, maybe a covered call would be appropriate. It would be appropriate particularly because of this bearish outlook over the next 6 months. Firstly, selling calls generates premium income. That would meet this objective of the client of alleviating this need for cash, or meeting this need for cash. And selling calls will reduce the delta of the position, reduce exposure to the underlying, and will take the edge off of any short-term downward movements in the near term. Notice that the client isn't completely bearish over the long term, isn't massively bearish over the long term, otherwise they would just sell the asset and generate cash that way. But they're bearish in the short term. They don't expect upward movements in the short term. They need to raise cash, so selling calls against their assets is a viable strategy. If the stock is worth 169, for example, we might sell relatively short-term calls with a slightly higher strike. That's a slightly out the money call option there. The idea is that option is unlikely to be exercised. We don't think the underlying is going to fall massively, or we're going to hold it for the long term. We're generating some income against our longer term holding. An out the money option works better than in the money. This is slightly out the money, isn't it? The right to buy at 170, something that's trading slightly below 170. In the money options would be called away immediately. You don't necessarily want to be called away here. You are a long-term owner of the security. You don't necessarily want to be called away. You just want to generate some income in a period where you don't expect prices to rise massively. If prices do rise massively, then you give up the upside above 170. That, of course, is the risk here. If the underlying does unexpectedly rise, you are bearish, or your client is bearish, but if the underlying unexpectedly rises, then you do give up that upside because your underlying asset gets called away. So that's strategy number 1, a covered call. Strategy number 2 is put writing. We haven't seen this explicitly during the reading as yet. Put writing, of course, is just selling puts. And when you sell a put, what you're doing is you're giving somebody else the right, but not the obligation, to sell the asset to you. So you could find yourself the proud owner of the underlying asset when you don't really want to be, because you're being exercised against someone is putting the asset to you when you write a put. You could use this when you want to buy a stock, you want to enter a position, so you want to purchase a security, but right now it's too expensive. So this is almost like a discipline mechanism. If we write puts that are slightly out of the money, when the underlying falls and hits that strike price and goes potentially below it, the stock will be put to me at that price, and that's me buying the security at my target entry price and generating some income along the way. Yep, so that this premium income that I'm generating along the way will offset any costs of the asset moving against me. If it moves too much against me and I find it being put to me and it's gone down too much, that will take the edge off that loss. So for example, if the stock is 169, that's the underlying again, and investors think, well, 165 is a good entry price here, we could write calls. They're out. We could write puts. Apologies. We could write puts at 165 strike. Okay, and we would get put to if the underlying fell to 165. Of course, the downside here, if the stock price runs away, it never comes back and we never get put to. So we do collect the premium income, but that probably doesn't more than cover the opportunity cost of not owning the asset. And the other risk, of course, is that the stock price falls not just, below 165 and the premium, but it keeps going down. Imagine if the stock fell to 120, you'd get put to at 165 still, and you're going to be suffering big losses, and you don't get the opportunity to react to whatever news has come out that's changed maybe the situation, which has caused the share price to open to trade a lot lower than the strike price. You'll just automatically get put to in that scenario. Okay, strategy number 3, generating some volatility exposure. We've seen a long straddle 2 or 3 times along the way now. We're going to see it here again. What sort of scenario would you recommend a straddle? If you've got a client that thinks, underlying prices could go up or they could go down, but we don't know which way, well, you need to just, it's that thing again about acting as a conduit between the curriculum and the case that's in front of you. You need to realise that if this volatility is more than what's priced into options, then this investor can benefit simply by buying a straddle. A long straddle is long a call and long a put with the same strike and same expiry. So, if we buy these options with a relatively low implied volatility and volatility turns out to be higher than what was priced into the options, then we win. Or put another way, if the market re-rates the options to have a higher implied volatility, then we win as well. What would be tricky is if there was a news story and volatility rose. In particular, if implied volatility rose. Some sort of news story which increased the perception of volatility in the underlying asset, that would increase the straddle price. Okay, so be careful then, because you wouldn't buy these options if the implied volatility is higher than the volatility than you expect. For example, if we now need 12% to break even, that's a higher volatility to break even, we wouldn't be interested in this straddle anymore. It's actually overpriced as far as we're concerned, because we only think that the stock is going to move up or down by 10%. So don't just think, if you want to buy volatility, you should buy a straddle. This is a little bit more sophisticated here. You've got to be very wary of what the volatility is that the investor think is going to play out. That does have to be essentially a level of volatility that is not already priced into options and then comes through and gives the investor profits as volatility plays out. If there is a news story and volatility rises, the straddle may no longer be worthwhile because high volatility is priced into markets. Obviously, the sensitivity to changes in implied volatility measured through Vega and a straddle buyer, as we've already said, a long straddle position, we're very interested in the positions Vega because that's the sensitivity to changes in implied volatility, re-rating the options values, which is what the strategy is all about. Okay, strategy number 4 is a collar. When would we recommend a collar to an investor? Now, don't forget what a collar is. Collar is long the underlying asset, long a put, and selling a call against it. What you're really doing is collaring your exposure between the 2 strikes, the low strike of the put and the higher strike of the call. So maybe we've got an investor who owns a stock and their entry price, as far as the taxman is concerned, is very low. So that would mean they're very sensitive to selling the asset, because that would lead to a potentially, or it would lead to a very large capital gains tax bill. So for tax reasons, they don't want to just go out and sell the asset, but they also don't want exposure because they're worried about a price decline. Now, they could go out and do a perfect hedge. They don't have to sell the asset to remove exposure. They could go out and do a perfect hedge, but maybe if they want to keep some exposure to the asset, they go out and they do a collar. A zero cost collar is one where the call that you sell pays for the put that you buy. We already know that from our previous discussions of a collar. We give up potential upside, really, through selling the call in order to fund our protection from buying the put. And we do maintain some exposure. You might remember that graphic where we're long the underlying, but we don't have exposure above the call strike because the call essentially starts losing money there. And we don't have exposure below the put strike because the put starts protecting us there. So keep an eye out for a client that says, well, I'm happy maintaining some exposure. I don't want to remove all of it by, say, selling futures or something like that. I'm happy to keep some exposure. I want it to be zero cost. What should I do? A collar is the strategy here. Also in the mix, this idea that you can't say to the client, "Well, just go out and sell it," because that would have too much of a negative tax impact on the client's position. Okay, strategy number 5, a calendar spread. Can we remember what a calendar spread was? Calendar spread is a theta play. It's playing two similar options with different expiries, as the name suggests. So you remember how theta is, looking at time decay and looking at how time decay is higher for shorter dated options. All right, that's one way to do a long calendar spread where you buy longer dated options and sell near dated options. But also it might be appropriate given a client situation. Let's have a look at this investor here. They're moderately bearish longer term in an index, but they reckon there's little movement over the next month or so. Okay, so that should throw up the idea that there's going to be heavy time decay in the short term, but longer term prices are going to move in a certain direction. So this is where we're going to sell the near dated options. Okay, we're going to sell near dated options, 3-month options, all right, short dated options if you like. We're going to sell those because we expect little movement over the next month and time decay is going to drag those options down. We're selling at the money options that we don't expect the index to go anywhere. It's going to drag that option price down, and we're going to benefit from that. We're going to buy 6-month options, which obviously have got a longer expiration. We think that over the longer term, there might very well be movements in the index, and they might very well be down. So over the longer term, in order to capture this difference in theta, the longer dated option, we are going to make it. We are going to make these options puts because overall our view is bearish. And once the 3-month option has decayed to 0, we should be sitting on a 6-month option. The 6-month option will now itself only have 3 months to go, but we should be sitting on a longer dated option which still has value. And this is a long calendar spread. Don't forget what you do with the longer dated option really dictates whether you've gone long or short spread. The ideal thing here is for our expectations to play out. The index stays flat, the short put expires worthless. The long put, as I've already said, declines in value, but it's still worth more than the net premium paid. So you're winning overall here. The risk here for a calendar spread, because you are paying for these options, they're exactly the same, but you're paying for the longer time to expiry, the higher time value for the longer dated option. The risk here is that you do lose money on the long dated option, okay, which doesn't pay for your net cost, which means that you're left overall underwater. We're using puts here because we are bearish longer term, okay, that's the key thing. And they've got the same intrinsic value because we've got the same strike here, but the longer put's got more time value. So, these are features of the strategy that we've already mentioned. The risk is that you lose your entire net premium. Now, when would that happen? That would happen when the underlying goes up and both puts go to 0 or pretty much to 0. That's when you lose your entire net premium, is when the underlying rallies strongly and so your bearish view was wrong. And yes, your short goes to zero, your short put, short near-dated put goes to zero, but so does your long far-dated put, which was more expensive, so you lose the net premium here. Okay, there's 8 strategies here, so 6 of 8, hedging expected volatility. This is a little bit different to what we've seen so far. You might sort of say if we expect volatility to pick up, we'd look at a straddle, but this is another way of playing a pickup in expected stock market volatility. Now, a key feature of volatility that you need to appreciate, or is often a central concern when it comes to trading volatility, is that when market prices fall, when prices fall, volatility tends to be going up. In other words, there's an inverse relationship between stock market prices and volatility. Prices tend to fall quite fast, and then they climb, slowly back up. Relatively speaking, they climb more slowly as they move back up. So there is an inverse relationship between being long and volatility. You could argue being long stocks, you're short volatility. When volatility goes up, that's likely to be when prices are falling, and that's going to hurt you. So this concern about high short-term volatility could be reflected, is really reflecting the concern that prices fall sharply. You could buy, if you're worried about short-term volatility, you could buy some options on the VIX, the volatility index. So these options are actually on VIX futures. So the VIX, the volatility index, is the implied volatility of the classic VIX index is the implied volatility of puts and calls, near-dated puts and calls on the S&P 500. So whatever index these VIX contracts are on, what they represent is the volatility that's baked into a stock market. If you're worried about that going up, why don't you buy a call on that volatility index so that when it goes up you win, and you can part fund that by selling a put. All right, so buy an at-the-money call, which might be quite expensive. You can part fund that by selling an out-the-money put to help fund this, what might be a relatively expensive call position. So yes, the premium income from the out-the-money put reduces the cost of the call. And, well, actually, before we bring that bullet point up, let's have a look at what we've done here. We've gone longer call on volatility, and we've gone shorter put on volatility. Does that look familiar? Plus C minus P. Yeah, all the way through this reading we've been saying that is a synthetic long. So we have synthesized a long position here, a geared long position, okay, in volatility. And that is a hedge because you have short exposure to volatility, presumably in your portfolio. In other words, it hurts when volatility goes up, because that's likely to be at a time when prices are going down. So this is like a collar. Except the difference here is you're not long the underlying, you are short the underlying asset, if you like here, which is volatility, and the call is protection against it going up. The short put is really selling some upside of lower volatility, selling some benefits of lower volatility in order to part fund the call. So yes, I mean, this is a relatively sophisticated strategy. In order to size this position, in order to work out how many options you should use here, you might very well want to regress the portfolio's historical profits and losses against changes in volatility to really think about, this sensitivity of your portfolio that you're trying to hedge versus changes in volatility, and that will give you, an idea of how many options you should use. You won't technically be doing that in the exam, but that's a suggestion as to a process as to how to size this position. Just be aware the number of options to use, they refer to that as the hedge ratio. Okay, the final couple of positions are really quite straightforward. You could always, strategy number 7, you could always use calls to gain exposure to the underlying. All right, so rather than buying the underlying, you get long exposure to the underlying by buying calls, going long calls. This is a strategy that might be appropriate for an investor that, well, they expect price rises, but they haven't got a lot of cash to invest right now, or they don't expect any adverse conditions for holding options. They don't have a lot of cash, so maybe buying options to get some exposure is the sensible suggestion here. So the question is, which calls should you use? I mean, usually you're looking at some sort of very specific time horizon, 3 months here that they've stated that are relevant to the client. Which options should you use? Well, given you have very discrete expectations that there's going to be quite a strong rally in this security, rising from 60 to 70, whatever it is, you're really just going to maximise, you're going to pick the option that you think is going to give you the biggest P&L over the next 3 months. So your P&L over the next 3 months is really how much 70 is, that's your, if you like, that's your expected final price. How much the underlying is above the strike and the call. Don't forget, you know, you need to be above the strike plus the call in order to break even, all right? So you're going to maximise this. How much 70 is above the strike and the call price. You're looking at lots of different calls here relative to the call price itself. You would, if you like, build a little spreadsheet, apply this formula to all the different options with your expected final price of the underlying and the strike of the different strikes of the options and the different cost of the options, and you'd pick the one that gives you the highest P&L, because that's what you're calculating here. Okay? You know, this here is your overall gain as a fraction of your overall cost at the outset. Okay, the final strategy we're going to look at here is, once again, a protective put. All right? Oh, by the way, a final bullet point here. You know, if you find a call with a break even, that's strike plus premium. Think about your basics of call options again. You have to go up above the strike by more than the premium to make money. If you find a call with a break even above 70, then that clearly won't work because you expect the security to go to 70. Okay, a protective put here. Similar idea. We know what protective put is. It's long stock, and you buy a put to protect yourself against falls in the underlying asset. And here we've got an investor that expects a share price to fall by up to 10% from 42 euros to 37.80 over the next week. Okay, so it's a similar idea as to what we had with the long call, and that is, let's just pick the option out of our universe of options. Let's pick the one that's let's pick the one that is going to give us the biggest P&L, and that's the optimal strategy. Okay, so don't forget, with the put we get to sell the underlying for the strike. So whatever the strike is, that minus the premium, because the premium always gets paid, that's what's coming in net. That has to be greater than the 37.8, which we expect the asset to move to. So that's once again our expected underlying asset price. So if you like, on the top there you've got your net gain from the option position. Express that as a percentage of the options value today, and you're looking at your overall percent P&L. Once again, you would maximise this percentage P&L. Once again, build a little spreadsheet, look at this little metric for all of your options and pick the one that has the highest expected P&L. Well, that concludes reading 15. Quite a few modules there. Like I say, this looks like a bit of an afterthought, this module, but this is very important because this is where it all comes together, and often in the exam you're applying your knowledge rather than, you know, demonstrating technical proficiency. It's picking the most appropriate strategy out of a list for a given situation.